Governor, the Aussie dollar, as you've mentioned, is very high relative to the terms of trade and has been at a sustainably high level for a period of time. Last night we saw the IMF suggesting that the Aussie may be added to its preferred reserve currency names. Given that's taking place, do you have any comment to make on whether that would in the medium term have an upward push for the Australian dollar? And is the spike that we're seeing in deposits from the foreign institutions at the moment at the Reserve Bank indicative of a way of leaning in or passive intervention in the currency?
Well, there's three questions in there, which gives me the option of answering the one I want to, but I'll have a go at the three. Terms of trade and the exchange rate, well, we've got models, we've got a few. It's a bit high. You wouldn't actually say it's more than a standard deviation away from the mean fit of the model right now, which is why what I've been prepared to say is I think it is a bit on the high side given what's happened. I'm a bit surprised it hasn't come down, which isn't to say it won't do so at some point. And I predict that if it does do so, we will go from complaining about it being too high to complaining about how fast it's falling without passing go. That's my first point. Second point, actually what the IMF said is that in the category of reserve assets that's presently labelled other, they may take Canada and us out of that and label us on our own. That actually isn't any sort of particular endorsement that makes us more of a reserve currency than we were. We've in fact been a small reserve currency for quite a few countries for probably 25 years. The Asian central banks in particular, most of them have had substantial Aussie dollar holdings for quite a while. We don't actually know how much exactly because they don't say, but in fact, if the IMF does this reclassification, we may find out, which would be probably handy. But I don't think there's as much significance to that. It's a classification change. It's not really any more than that. As for the recent so-called passive intervention, let's say that was customer business that we decided to keep on the balance sheet because the prices seemed attractive to do that at this time.
Stephen Martin mentioned that you're one of two Australian officials who are members of the Financial Stability Board. And I wonder if I could draw you on your views about the evolution of financial regulation, both internationally and here in Australia since the global financial crisis. So to be specific, are you comfortable about the trends that are emerged from the Financial Stability Board and their application to our circumstances here in Australia? And depending upon the answer to that question, can I draw you on the likely impact of the regulatory trends that we've emerged, that we've observed, and their impact on the structure of the Australian economy over the next 5 to 6 years or so?
Well, you asked the question of someone who, when he attends Financial Stability Board meetings, travels further than others, than anyone else, and therefore endures more jet lag and has the latest start time to the conference calls, which is usually 11 p.m. So at times I sort of may have an unduly jaundiced view of the process. The first point is, I don't think there was any, having seen what happened, we've had a major financial crisis. There were clearly some failings in the supervisory and regulatory process. I think it's hard to deny that. We didn't have them here, I don't think. I think our supervisor did a good job, and I would say, as I've said before, I think by and large our major financial institutions were quite carefully managed, and that's to their credit. But in other countries they did have problems, so you're always going to have some kind of regulatory response to that that event. I don't think there's any doubt that the largest global players, the dozen or 15 really genuinely G-SIFIs, to use that expression, did not have enough capital. They were over-leveraged, and they suffered liquidity problems as well, partly as a result of the balance sheet strains. You can't let that persist. You have to try to, I think, reform the system to have more capital in institutions like that, higher quality capital, genuine loss-bearing capital, and at least some more attention to liquidity management and so on. Then there's a whole bunch of other agendas under the FSB, but let me just stick with the major institutions. That set of arrangements, by and large, has very little bearing on our banks. Our banks are not G-SIFIs. They will be D-SIFIs. They will be, under the systemic framework for domestic institutions, they will be captured. And that will say to hold a little bit more capital, not on the same magnitude as your JP Morgans and these other very, very large global banks, but a little bit more. I don't think it will actually be that hard for them to meet that by the time it comes in, which is some years away. I think one has to accept that it's likely that in the global banking system, yes, insisting on more capital to lessen the probability of the state having to step in again, it raises the cost of intermediation to the community. That's correct, but I think, in all honesty, the community just has to accept that because the price of intermediation appears to have been too low before, and I think we've got to accept some change there. Of course, we have to modulate that, calibrate it, and I suppose, to come to your question, the thing I've found perhaps a bit unnerving about all the regulatory reform process is the sheer speed with which very important decisions have been made. I understand the sense of urgency that we don't feel here, but my peers in America or Britain or Europe do feel. You can see why they feel that. Nonetheless, Basel II took 20 years to negotiate. Basel III took 18 months to agree. It comes in over a long time, but that was a very accelerated process of agreement. We're already finding in certain areas that some quite influential countries are feeling the need to tweak some of the parameters. So there's a risk of unintended consequences if you're not careful that comes with speed. I've felt myself a little uncomfortable with that. Most of these things I don't think are going to be a great drama for us. You know, some attention to capital, but APRA has always had pretty conservative definitions of capital. Therefore, the capital shortfall that would exist under the new rules is much smaller generally for our banks than it would be for many others. That reflects very well on APRA. And on the liquidity side, which was the other big thing, we've managed to find a way of handling the needs there. So I think for Australia this is manageable. For the globe, it's a lot of progress in a very short time, and we need to be very attentive to the possibility of unintended consequences, and I think that extends not just to bank regulation, it extends to the work on OTC derivatives clearing, it extends to things like Volcker rules, etc., and the European equivalents. All these things, it's going to be some time, I think, before we know for sure whether we've pitched them exactly right. But I think that's just almost, you know, unavoidable in the circumstances we're in. That's a long-winded answer, but I think that is an important question.